What if I told you there's an ETF paying over 11% per year straight to your account every month? No stock picking, no day trading, just passive cash flow. Sounds like a dream, right? But this dream comes with a price. Meet QYLD, the Global X Nasdaq 100 Covered Call ETF. Today we're breaking down how it really works, what kind of net gains you can expect, and why some investors think it's a yield trap in disguise. Stick around to the end, because I'll show you how smart investors are using QYLD strategically without letting it drag down their portfolio. Let's start with the basics. QYLD holds the Nasdaq 100, like QQQ, but adds a twist. Every month, it sells covered call options on the index. The premiums collected from those options get paid out to investors as monthly dividends. It's a rules-based strategy, simple, passive, and consistent, but it's designed for income, not growth. QYLD currently offers a dividend yield around 11 to 12%, paid monthly. If you invest $10,000, you might see around $110 a month in income. But here's the catch. That yield doesn't come from growth. It comes from selling upside. And the result? QYLD's price has been steadily declining. Over the past 5 years, it's lost more than $4.30 per share. Since inception, it's down over $8.60. That's a drop of more than 30% in long-term value. It's like renting out your car for cash each month, while slowly watching it lose value. Eventually, you're left with a check and a beat-up car. Here's why it happens. By selling covered calls, QYLD is capping its gains. Every time the Nasdaq 100 rallies, QYLD is forced to sell away the upside through its call options. So while QQQ rides the tech wave up, QYLD sits on the sidelines and collects premiums, but misses the rally. That's why QYLD performs better in sideways or choppy markets, but falls behind during bull runs. Now let's talk about expenses and taxes. QYLD charges a 0.6% expense ratio, which is relatively high, especially considering its long-term underperformance. It is, however, highly liquid, with over $7 billion in assets and a large investor base. But one more thing. Most of QYLD's dividends are taxed as ordinary income, not qualified dividends, so your real yield may shrink depending on your tax bracket. Let's break down the pros and cons. Pros: high monthly income. Simple, rules-based strategy. Performs best in sideways markets. Cons: capped upside during bull runs. Long-term price decline. Dividends taxed at higher rates. So, who should consider QYLD? It might work if you're focused on income now and don't care about long-term growth. That could be retirees, early FIRE investors, or anyone using it for supplemental monthly income. But if you're still trying to build wealth, QYLD might actually slow you down. Even income-focused investors are usually better off limiting QYLD to 5 to 15% of their portfolio. Use QYLD for income, but balance it with growth ETFs like VTI, SCHD, or XLK, so your portfolio doesn't flatline over time. As always, this video is for educational purposes only. Always do your own research and consult with a financial advisor before making investment decisions. If this video helped, a quick like would be greatly appreciated. It really helps small channels like mine grow. And subscribe to Opportunity Odyssey for more ETF deep dives and passive income strategies. Let me know in the comments. Do you think QYLD's yield is worth the risk? Thanks for watching, and I'll see you in the next one.